Imagine making money by predicting if Jesus is going to come by the end of the year or if Canada will enter a recession. Canada recently introduced one of the most controversial financial products in years. It's called the prediction market. Some people call it the future of forecasting. I think it's gambling dressed in a trench coat. A prediction market allows you to buy and sell contracts based on the outcome of future events. Here's how it works. Suppose there's a contract that asks, will Canada enter a recession before December 31st? If the market thinks there's about a 70% chance, that contract might trade for around 70 cents and you can buy in at that price. If the recession happens, the contract may pay $1, so you've made a profit. If a recession doesn't occur, the contract expires worthless. Essentially, the market price becomes an estimate of the probability of that event occurring. The market is basically a place to speculate on future events and also a place to source for market information, as every trader brings new information, research, and opinions into the market. As people buy and sell, prices adjust to reflect the crowd's collective expectations. This is big for Canada because for years, Canada had strict rules around short-term binary event contracts. So all the wonderful platforms you know largely couldn't operate within the Canadian regulatory framework. In recent times, Canadian regulators created a pathway for certain prediction contracts to be offered through regulated investment dealers under security and derivatives rule. The initial focus is on contracts tied to financial markets, economic indicators, and climate data. That means prediction markets are gradually moving from the gambling conversation into the investment conversation. Supporters argue that prediction markets help improve price discovery, aggregate dispersed information, and helps investors and businesses understand future risks. Critics argue they blur the line between investing and gambling, encouraging speculation on things that have little to do with creating productive economic value. Some also worry about the potential for manipulation and insider information, and these concerns continue to shape regulation. So for individuals who wish to get involved in this, the important thing is understanding what prediction markets are. You're not investing in businesses, you're not building long-term wealth through productive assets, you're trading probabilities. And while prediction markets may become an important tool for forecasting economic events, they should never be confused with the fundamentals of long-term investing.